In our series of researching 10 companies requested in a comment, next stop we will take a look at MSC Industrial Direct, which is based in the US and founded more than 80 years ago. They have almost all their business, which is creating tools and machinery inside US. They have been growing their revenue steadily at a very slow pace, keeping up with inflation with a narrow net margin, which is expected for these type of industrial businesses. They don't have a sustainable competitive advantage over their competitors, which is what we are looking for. There is a lot of pressure on their margins, so they need to lower their prices all the time to stay in business. They are low on debt compared to their earning and free cash flow, something like 2 times, which is manageable. But the fact that they are always low on cash and all their assets are tied up in receivables, inventory, plants, and intangible tells me they may be a good business, but they are definitely not a wonderful business, which is what we are looking for. Their receivables and inventory have grown 75 and 60% respectively in the past 7 years, but their revenue and cost of goods sold increased 30 and 50% in the same time period, which are important indicators for industrial companies and show if they are able to turn their products into cash easily or not. With an earning of 350 million and market cap of 5.5 billion, they are a cheap industrial company, and we are looking for monopolies that we can own for decades. All they do is earn some cash and pay almost all of it as dividend, which is good, but not what we are after. So we are gonna remove them from our list and look for another opportunity. Thank you for watching this episode. Please make sure to like the video for the YouTube algorithm, subscribe to the channel if you have not done so already, check out Simply Wall Street offer linked in the description and try it out, and next watch this playlist with more companies research. Have a great rest of the day and see you on the next one.